The last few days have been a comedy of errors with everything that could go wrong with my software. I'm doing some trainings called the diversification myth, where I show people how what you really want to do is study crashes. And if you can study crashes, specifically stock market crashes, you can learn a great deal about how the market actually works. And the car companies are very good at this. They deliberately crash their own cars to see how things work, and it's in the crashing of their cars that they learn about how to build better cars. And I took that idea a long time ago and figured that if you did study stock market crashes or very large corrections or collapses, however you want to frame it, you could learn a lot about the market itself and see things that other people aren't seeing. Because after all, crashes do happen, collapses do happen. So if you understand them, then you can understand everything. And though Mike Tyson isn't really considered a highly quotable financial expert, one of my favorite quotes ever about the financial markets is from Mike Tyson, and he was being interviewed about his boxing match coming up against, I believe it was Larry Holmes. I am so bad at boxers' names, but one of the interviewers said, Holmes has got a plan for you. And Mike Tyson said, everybody's got a plan until they get hit. And I think this is true with the stock market. Like, everybody knows what to do until the market starts crashing, and then they realize they don't have any plan. So with that, I want to talk about what is going on in the market today. It is a very, very interesting market. The closest market we have in the last 145 years is the 1950s, or the market in the 1950s. But specifically today, I want to show you one price chart and talk about what the heck is going on. Hey everybody, this is RC Peck, and this is my weekend podcast. Thank you so much for being here. The theme for this weekend is stuck. The S&P 500 is absolutely stuck from a S&P 500 point of view, a pretty tight channel, about a 13% channel from top to bottom, and it is stuck in it. When it tries to break out to the upside, it gets stopped, and when it tries to break down below that strong support, 13% below, it gets stopped again and is going up and down. This is the S&P 500 price chart that you see right here on the screen, and as you can see this is 2014 and 2015, some pretty crazy drops. Now, from a percentage point of view, they're not that big, 10, 11, 12%. For a 10 to 12% drop in the S&P 500, that's not that significant. It happens on average once a year. What's significant about these drops is, first of all, there's two 10% plus drops within 5 months of each other, right within 4% of the lifetime highs. So that right there would tell you that there's a potential topping pattern. But then every time the S&P gets right around this 1875 mark, and let me put some visuals on to help you down below here about this 1875 zone. And this is the close of day. You're looking at a daily price chart. That line represents the closing price each day of the S&P 500. And if you look at this lower support zone, it's the close of day price. And every time it gets down into, I'm calling this the 1875 zone, it stops falling. It did it in October of 2014. It stopped falling in August of 2015. It stopped falling in October of 2015. And here we are just this week. It stopped falling in, let's call it January of 2016. So that 1875-ish zone, and I put the ish on it because it's not the exact price point of 1875. It's plus or minus 1875, about 25 points. Plus or take. So that's a strong support. And then you have this strong resistance at the top until it decides, it being the S&P, until the S&P decides really what to do. And it's looking into the future and it's trying to figure everything out, what's going on in the future. And it's looking at all the information. And kind of from a bearish point of view, what the S&P is seeing is the 50-day moving average is below the 200-day moving average. The 200-day moving average is sloping down and is flat, both negative. I probably should have said it's flat to sloping down. The equal weighted S&P 500 is greatly underperforming the S&P. It sees that. It's looking at the yield curve, and the yield curve has broken below a major support. Now, it's just barely broken below. The major support is at this 1.21 zone. So because of what I said with the 1875 zone with the S&P, it's not a specific number. But the yield curve has broken below a major support. Now, it can kind of dance right around that major support zone and not mean much right now, but it has broken below. And that, again, all things being considered, is not a good sign. And then you have Europe greatly underperforming, emerging markets greatly underperforming, and China greatly underperforming the U.S. itself, with small cap and mid cap also greatly underperforming. But then on the kind of the bullish side of what the market is seeing, it sees that the long-term treasury and the midterm treasuries, they completely stopped on a resistance. So there's some resistance above them, and they stopped. They backed off from it. It can see oil has stopped falling in the last few days. Now, is oil done falling? No one knows. The next major support really is around the 26 zone, and we're back up to 32, but we dipped down into $27 a barrel. So it still is in a downward trend, and that part is bearish. The bullish part is it has bottomed, possibly a short-term bottom. And then you have junk bonds that, from a positive or bullish point of view, have also bottomed with the market temporarily here. We don't know if that's a full-time bottom. But then on the bearish side, you could say, yeah, but junk bonds are still crashing, and they've fallen so hard over the last 2 weeks alongside oil, they're just probably taking a breather. So there's a lot of information out there that literally the S&P 500 is looking into the future. Hundreds of millions of free-thinking people putting their money where their mouth is and their opinion is. They're looking at all these. They're digesting all this information. And what you have here, which I think is it's pretty amazing. What you see here on the screen is a visual depiction of how humans are trying to decipher what is coming towards us in 3, 6, 9, 12 months. And that's, to me, what's so beautiful about looking at price charts. They look into the future, especially one with the S&P that represents about $19 trillion in stocks. A lot of people are looking into the future, trying to figure it out, and it's digesting that information and then making some moves. Now, I do want to show one more thing. This is the only price chart I want to show you today. But below, we have this intraday low. So it's this lower zone to the support zone. And I told you before that the support zone that is holding the market up is right around that 1875. But that's just the close of each day. Within these days, we've had some pretty big intraday moves. We had one this week. We had one back in August. We had one in September. And so what you're seeing on the screen is that if you take into account the intraday moves, the price of the S&P can fall as far down to 1825. So we have a lot of movement here. The point is, when we get to these support or resistance zones, they dance around the zone. They try to figure out, should I break out? Should I break down? How many people are buying? How many people are selling? And that's ultimately what's happening at these red bars on the screen. At the very top, what's happening is people are selling. They're getting out of their positions. They're saying, look, let me liquidate. Let me lighten up the load. And then when we get to the bottom of this channel, being stuck in this channel, people are saying, hey, you know what? Maybe I'll pick up a few more. Maybe I'll put in another 5%. And so that's what happens with all channels. And this is a pretty tight channel, though it looks tall because I did not compress it visually. But a 13% channel for this long is on the narrower side for the S&P 500. So what is the takeaway? What is it that you should do? Well, really, until the market breaks down or breaks down and out of the channel, or breaks up out of the channel, there is not a lot to do. I mean, if you're a trader, you want to be buying right now where the market is bottoming right now. Now, is it a long-term bottom? Is the market going to go up for the next 18 to 24 months? I don't know. Right? People can speculate, but we don't know. But if you're a trader, right, looking to hold things 1-2 months, then this is the time to say, okay, you know what? Let me get in. Let me set my stop losses and all the stop loss mechanisms that I have, and now is the time for traders to get in. And then at the very top, it's a trader's market again. That's the point where they would maybe short stocks or buy inverse funds. But until we break out of this channel, we have to wait and we have to do our best to be patient, because it is literally just stuck. And that's what we really need to do is, up or down, the market has no opinion yet, or it is digesting the opinion of, hundreds of millions of people putting their money in the markets. They themselves are looking into the future themselves collectively and independently and figuring out what it is that the market should do next. And the answer is we don't know yet. But the big takeaway is to have a strategy, have an approach that can give you perspective, right? So should you start freaking out? Should you start being like, oh my gosh, everything's going to go to the moon now? What you should do, or what you may want to do, or what I've found that is very effective, is have some markers, have some signals, have some alerts to say, hey, we should start paying attention now. Hey, we should start freaking out now. Hey, we should, or not. But the problem is people don't have alerts, or they don't have signals. So their brain, their critter brain, which is their oldest part of the brain that is on top of the brain stem, which just above that is the limbic system, which manages emotions, it freaks out and literally goes crazy because it thinks you are in danger, and we humans make bad choices, and that's what's going on with these huge swings, visually huge swings in the market, and that's what's happening now. But the takeaway is, up or down, the market is digesting, and the market has to figure things out. I want to thank everyone that was very patient with me while I was figuring out some software issues with my training, the diversification myth, this past week. I really appreciate the kind of the world, the people that are in my world, even though I didn't mean to waste their time, but because things weren't set up properly, my fault. They went to watch the training live at a time when it wasn't happening because things got messed up. So I want to apologize to everyone. A lot of you emailed me and asked me what was going on, and I did get back to most of you. I got back to everyone who emailed me, but I just want to thank everyone for just being patient and gracious, how you have managed your emotions through that. Very stressful on my end, but I managed to work it out. Thank you, everybody, for being in my world, and I will speak to you soon. Until next time, this is RC Peck, and this is just another step in helping you protect and grow your future.